Welcome to our monthly macro and strategy update. This month, we'd like to talk about our main takeaways from the latest central bank decisions. The global economy continues to recover, particularly in developed countries, with the services sector rebounding in the beginning of the fourth quarter. Regarding the economic outlook, we project a growth slowdown, but economic activity will remain above potential in the coming quarters. This is due to further improvement regarding vaccine access, companies filling up their stocks again, easing supply disruptions, as well as savings that were accumulated during the crisis and that acts now as a cushion for domestic demand and consumer spending. One major highlight in the past month has been a range of central bank decisions. In America, the Bank of Canada has announced the end of its quantitative easing program. In the US, the Federal Reserve has announced a reduction in its QE program, surprising no one by the size of the reduction announced nor its timing. For us, these are baby steps towards a normalization of monetary policy, and we are reminded that monetary policy remains very accommodative in the US. Less QE is not QT or quantitative tightening. Indeed, the balance sheet of the US Central Bank will continue to rise in coming months. We expect the end of net purchases in June next year. In contrast to that, on this side of the Atlantic, the European Central Bank is maintaining its very expansionary policy. Indeed, ECB President emphasized that an interest rate hike next year is highly unlikely. Now, on our side, and turning now to concrete investment allocation decisions, we decided to neutralize our position of the euro versus the Swiss franc. We believe that the European Central Bank will remain very accommodative, and the upside potential for the euro relative to the franc is limited. Hence, we expect going forward a lateral movement in the US-Swiss franc currency pair. This is the first decision we took recently. A second decision we took includes our fixed income exposure. We keep our strong underweight in sovereign bonds. Furthermore, we decided to invest in floating rate notes, both in the US and the UK, which will benefit from the incoming rise in policy rates in these two countries, and which will offer higher yields than money markets. Thank you very much for your attention.